As of 10:31 a.m. Eastern Time, Rezolve AI plc, trading on the Nasdaq under the ticker RZLV, is at $3.14 per share. That's a drop of 10 cents, a 3.22% loss on the morning. Now, for a stock this cheap, a 3.22% move might seem like just another day of microcap volatility. But what you are watching is not a stock finding its footing. What you are watching is the slow, agonizing, and almost complete collapse of a $2 billion SPAC fantasy. This isn't a dip, it's a financial unraveling, and today's drop is just the market confirming it's not done falling. The immediate surface-level expectation for RZLV is one of the most compelling and dangerous in the entire market. This company is a pure-play AI company. If you log into your Fidelity brokerage account or check your SoFi Invest app, you will see a company that, on paper, looks like a rocket. You'll see press releases, one after another, boasting about a $500 million ARR exit rate for 2026. You will see headlines about a partnership with Microsoft, a partnership with Google. You will see them claiming to have processed over $50 billion in gross merchandise value this year alone. And to top it all off, you'll see a row of Wall Street analysts from firms like H.C. Wainwright and Cantor Fitzgerald with strong buy ratings on the stock, with price targets of $7, $9, and even $10. That is the expectation. It's a story custom-built for the Robinhood generation, for anyone using online investing tools and looking for the next NVIDIA stock. It looks like the ultimate asymmetric bet, a $3 stock with a $10 target, backed by AI and giant partners. The reality, however, is that this company is a financial house of horrors, and the $3.14 stock price is a testament to a market that is no longer buying the story. The reality is that Rezolve AI is a classic de-SPAC. It came public in August 2024 by merging with a shell company called Armada Acquisition Corp. I. That SPAC deal, pitched back in 2021, valued the combined company at a pro forma market cap of $2 billion. Today's $3.14 price, down from a 52-week high of over $8 and a world away from the $10 SPAC trust value, shows you what the market actually thinks of that valuation. The original deal expected to deliver $190 million in gross proceeds, but like most SPACs of that vintage, it was likely a high redemption deal, meaning the company got its public listing but almost none of the cash it was promised. This disconnect between the press releases and the balance sheet is the entire story. Let's look at the financial reality that the strong buy ratings, which offer terrible investment help in this case, conveniently ignore. You don't need a sophisticated Fidelity trading platform to see this. The public filings are a nightmare. As of its last major report, Rezolve AI has about $9.86 million in cash and cash equivalents. That's it. $9.86 million. Now compare that to its debt. The company is sitting on $35.55 million in total debt, but it gets so much worse. Its total current liabilities, the bills it has to pay within the next year, are $93.65 million. Its total current assets, only $22.58 million. This gives it a negative working capital of over $71 million. In plain English, this company is insolvent on paper. It does not have anywhere close to the funds to pay its short-term bills. And what about that explosive growth? The company's cash from operations on a trailing 12-month basis is a negative $36.55 million. It is burning $36.55 million just to exist, and it only has $9.86 million in the bank. This is the central conflict, and it's why the stock is dropping 3.22% today. The market is watching this company drive 100 miles an hour toward a concrete wall. So what about all those headlines? The $50 billion in GMV? This is the magic trick. That GMV is not their revenue. It's the total value of stuff processed through their platform, but they get to keep almost none of it. Their actual, real revenue, the money they book, last quarter was just $6.32 million. Their net income? A loss of $173 million. The strong buy expectation is built on PR. The $3.14 reality is built on the balance sheet. and the balance sheet says this company is running on fumes. The only reason it's even still alive is a $15 million growth capital raise they managed to secure, which is just a band-aid on a gaping wound. This isn't a growth stock like Apple stock or Tesla stock, which generate oceans of cash. This is a story stock, and the story is falling apart. So what does Rezolve AI actually do? The pitch is agentic commerce. They have an AI platform called Brainpower that's supposed to be a commerce-specific large language model. The idea is that their tech allows for scan-to-buy features, letting you use your phone to interact with ads or products in the real world and buy them. It's an AI-powered engagement tool for retailers. The partnerships with Microsoft and Google are likely just cloud credit deals, allowing RZLV to run its platform on their servers, which is something those tech giants offer to thousands of startups. The press releases make it sound like they are co-developing the next generation of AI, but the reality is they are almost certainly just a customer. The stock's performance reflects this. It's down over 50% in the last 6 months. It's a darling of self-investing retail traders on the Robinhood app who see AI and Google and a cheap price, but it's being systematically sold by anyone who has read the financial statements. This isn't a holding you'll find in a Schwab Intelligent Portfolios account or a Fidelity Managed Individual Brokerage account. The professional money outside of the small-cap-focused analysts is staying far away. The future outlook here is binary, and it's almost entirely bleak. The overwhelming risk is a financing-related death spiral. The company must raise capital to survive the next 2 quarters. Because its stock is at $3.14 and its financials are so terrible, the only investors who will give them funds are going to be predatory. They will be forced to do an offering of shares or warrants at a massive discount, perhaps at $2 or $1.50, just to get a few million dollars in the door. This will be catastrophically dilutive to current shareholders. Everyone holding the bag at $3.14 will see their stake in the company evaporate as millions of new, cheap shares flood the market. This is the de-SPAC playbook, and it rarely ends well for common stockholders. The other risk is a litigation. The stock has a 52-week low of $1.07. It's not hard to see it breaking that and heading under $1, at which point it will get a deficiency notice from NASDAQ. Is there any catalyst? The only bull taste, the only thread of hope is that the company's story isn't a complete fabrication, that the $100 million ARR projection is real, and that a massive contract like the $9.8 million annual deal they announced with Liverpool, Mexico, is just the beginning. The hope is that they can cross the chasm and reach cash flow positive before they go bankrupt. With a tiny float, any real news, not a PR fluff partnership announcement, could send this stock squeezing violently. This is what the Robinhood stock trading crowd is betting on. They aren't using SoFi ETFs for stable growth. They're at the casino. I'm genuinely curious what people think. Comment below. Are those strong buy ratings from analysts completely delusional, or do they see something in the brain power tech that the balance sheet is hiding? In the end, Rezolve AI is the perfect embodiment of the market's current schizophrenia. The expectation, fueled by a torrent of AI hype, analyst endorsements, and impressive-sounding GMV numbers, is that this is a $10 stock in the making, a leader in a new field. This is the story that online investment platforms and investing sites are all too happy to show you. The reality, reflected by today's 3.22% drop to $3.14, is a company that came public via a broken SPAC, is burning through cash at an unsustainable rate, and has a balance sheet that screams insolvency. The market is telling you right now that the press releases are hot air and the company is in a desperate fight for survival. The $3.14 price isn't a discount. It's a warning. Disclaimer. This content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.